What is up, guys? Welcome back to another video. Today we're going to be talking about an in-depth I'm going to be going over an in-depth lesson on the market maker model. So today we're going to be using Euro USD here on the 15-minute time frame. Okay, so we have here we can see that price has been on the higher time frame bearish from the 15-minute time frame, right? We have this low here to the left, and we have created some relatively equal lows. So there's lots of buy side here. Let's see. Okay, so we have lots of sell side underneath these lows here. Okay, price has been bearish. We're starting to consolidate in here. You can see we're in the Asian session here during Euro USD. We have this old high as a form of buy side liquidity here. Lots of liquidity resting above these highs, especially in here. We also have the remainder of this 15-minute buy side inefficiency, sell side imbalance in here. Okay. So the remainder of that old 15-minute fair value gap in here. Okay. This candle's low to this candle's high. There's a gap in there that still has to be traded up into. All right. We drop down to the 5-minute. We can see price took out the relative equal lows in here in the form of this sell side liquidity as this run. And we also took out these relative equal highs in the form of buy side liquidity here. Okay. So we can expect price to draw back up into this 15-minute fair value gap and this old high as buy side liquidity. Okay. So this up here on the higher time frame is our draw on liquidity. Okay. So price is clearing out liquidity here. We have our original area of consolidation. Okay. And this is the start and the base of any market maker model. Okay. This is the original consolidation before we have our accumulation stages 1 and 2. We'll have our smart money reversal, and then we'll have 1, 2, maybe sometimes 3 stages of distribution. Okay. So we're clearing buy side and sell side in here. Okay. This high and low that clears out both sides of the market on this 5-minute time frame is your dealing range high and your dealing range low. Okay. This is the high and low of our original consolidation in this area. Okay. So you can see we generated some liquidity here in the form of equal lows right here. So price will want to come back after we create our model here on our buy and sell side curve of the model to take out these lows here. Okay. So if we measure our initial consolidation, this is our equilibrium of that dealing range. Okay. This is 50% or halfway of that dealing range in here. Okay. We can see price then creates a bullish fair value gap. We have displacement, market structure shift above. Okay. So this is our initial consolidation. Price starts to heavily push away. We come back down into equilibrium of that initial consolidation in here. We also have an order block right here that we bounce off of that is in confluence and lines up with that equilibrium of this dealing range or initial consolidation, with our draw on liquidity being the 15-minute fair value gap and the old high, that buy side liquidity. Drop down to the 1 minute here. We can see that price stopped at consequent encroachment of the rest of this liquidity area, right? the candles will tell the story, or the candle bodies will tell the story, but the wicks will do the damage, right? So the candle bodies are showing the price is unwilling to continue to deliver higher in this PD array in the form of this 15-minute fair value gap and this old high on buy side liquidity. Okay. We cleared out buy side down here and sell side. We also have a small breaker in here. So we have this low, high, lower low. So price came back into this area, bounced off, and then we drive higher. We also left these equal lows down here to later come back because we've generated liquidity below here. Now there's sell side liquidity underneath our initial consolidation area. We can see this is our buy side of the curve and our sell side of the curve. Price came down and we have a shallow sweep of these lows underneath our original consolidation. Now, how did we get there though? Right. So we have our first stage of accumulation here. We drive higher, second stage of accumulation into this bullish fair value gap, and we drive higher into that draw on liquidity in the higher time frame. So we have our breakaway gap, we have a measuring gap in here, and then we have a regular fair value gap in here. After we reach that 15-minute fair value gap here, we respect these lows. Price is just respecting time here and respecting this level. We then drive aggressively in the form of this down close candle and break this low. Okay, we have displacement there. We have a break in market structure here with the candle body close down here. So this is your change in the state of delivery here. Okay, price displaced beneath these lows. And then we leave this fair value gap. Price then drives up into that fair value gap. This is your low risk sell after that smart money reversal. Okay. Now, why did we not completely close in this bearish fair value gap? Well, if we look to the left here, we have this bullish fair value gap on the left side of the curve, on the buy side of the curve. Okay. So price has already came down. We've balanced out this price range. And so there's no need for price to continue to drive higher. This is why this is also your low risk sell. Okay. We then break lower aggressively again beneath the second stage of the buy side stage of accumulation here in another form of a break in market structure. Okay. We leave this fair value gap here, drive up into it. This is your higher probability entry. Okay. We also, this is our first stage of distribution. Okay. So we have our low risk sell and then our first stage of distribution in this area in this fair value gap. We also have this bearish breaker in the form of this down close candle here. So we have this high, low, higher high, and then we close beneath this low, leaving this breaker. Price then drives to the bottom discount of this breaker and the bottom half of this bearish fair value gap on the 1 minute. Now, why did this not go higher and close in here? Again, we have this bullish fair value gap on the left side of the curve. So we have a balanced price range. So price has no reason to want to drive higher. Okay. We then drive lower. Even again, we leave another fair value gap in here. We also have now this order block here, this bearish order block that we reject from. Okay. This is your second stage of distribution. Okay. We also have on the left side of the curve, of the buy side, we have this bullish fair value gap that acts as almost an inversion level or a quote unquote true resistance, right? We drive up into that bearish fair value gap here, the order block, and then we can stay inside in here, but we stay on the lower end of this inversion gap here. Okay. This is your silver bullet on the sell side of the curve. Okay. This is your second stage of distribution, also known as the silver bullet. Okay. Price hangs around here for a few minutes, and then we aggressively drive down, right? We have our measuring gap here, which also lines up with the measuring gap on this side. And then we have our breakaway gap. And then we come back and we sweep these lows. Now, this was just a shallow sweep here. And if we notice, we have our first and second stage accumulation are above equilibrium of this whole price range here. Okay, this sell side delivery range. So more than likely, most of the time, price is going to want to run even lower here because we just had a shallow run here. We want to run to and through the original consolidation here in the form of these equal lows. Okay. Now, where will price go to? We can take the swing high and low of this manipulation leg here and project down 2 to 3 standard deviations. Okay. So somewhere around 2.5 in between 2 or 3 could be our objective for price to sweep the rest of these equal lows. As you can see, we hit just below 2.5 of the standard deviations down in between 2 and 3 standard deviation. And we, in the form of 1, 2, 3 drives lower here. Okay. Before we start coming back up into this range. All right. And this is how price is delivered algorithmically day in and day out. Okay. This is perfect. This time frame is perfect for intraday traders, scalpers. Now, since price is fractal, you can do this on all time frames if you want to swing trade or something like that, intraday trade. But you can see how the market maker buy and sell models can be very powerful. And once you understand these models, finding your setup, like a silver bullet trade on the second stage of distribution, which is ICT's favorite, right? This is what he's going to use for the Robbins Cup 2024 to win it. So you can see how powerful these are. All right. Now, if you want to, if you liked this video and more in-depth topics like this, come over and join our bootcamp starting tomorrow. It starts tomorrow every Monday for 2 hours. We are going to start at, what time is it? Central Eastern time. It's going to be 9 a.m. Eastern Standard Time from 9 to 11. Okay. Every Monday. It's a one-time payment. You get lifetime access to our Discord if you do the bootcamp, or if you want more in-depth videos that you can watch over and over again. I do have the master course you can get, or if you just want to be in the Discord and for a one-time payment of $50, super cheap to get in. Live trading from Tuesday through Thursday. We trade the silver bullet. So yeah, would love to have everyone in there. But bootcamp starts tomorrow. Get in there. You get the Discord included in the bootcamp, lifetime access. So you're going to get both the November bootcamp, which starts tomorrow, and lifetime access to the Discord, which we live trade in for $97 there. So don't forget that, hit that like, comment, and subscribe. Until next time, guys, thank you so much and trade safe.